Do not plan another energy project without understanding how the ITC, PTC, and 179D deduction restructure your capital math because the ITC can offset a meaningful share of installed cost, and the 179D can add up to $5.81 per square foot in deductions when labor requirements are met. Combined, these compress the payback on projects you're already planning. I am Daniel Burke, and this is Energy Answers brought to you by Tactical Energy Group. If your electric bill runs five figures or more every month and you're evaluating a retrofit, a solar install, a battery system, or any major building upgrade, this episode is absolutely for you. So here's the short version. There are three federal mechanisms that reduce the cost of energy projects: the investment tax credit, the production tax credit, and the Section 179D deduction. The ITC cuts your tax liability based on what you spend at installation. The PTC pays you per kilowatt hour of electricity generated over roughly 10 years. And the 179D is a deduction tied to how much you reduce energy costs in a commercial building. The question for your operation is whether your project qualifies, what it's worth in actual dollars, and whether you're making the right decisions before you bid the work, because some of these decisions cannot be undone after the fact. Now, back in episode 12, we built the ROI case for LED retrofits. In episode 14, we talked about battery storage and peak shaving. And next week, we'll be covering high efficiency HVAC upgrades. What we didn't cover in any of those episodes is how federal tax credits compress the payback on every one of those projects. And today, we're going to fix it. We're decoding three instruments: the ITC, the PTC, and Section 179D. By the end, you will know which one applies to your project type, what it's worth in today's dollars, and what decisions you need to make before the project goes out for bid. So, what's the difference between the ITC and the PTC? The ITC, the investment tax credit under Section 48, is based on total installed cost. You spend money on a qualifying renewable energy project, and you get a credit against your federal tax liability at installation. Immediate. The production tax credit, the PTC, works differently. It pays a per kilowatt hour credit for electricity generated by qualifying sources like wind, geothermal, biomass, and hydropower, typically over 10 years. The ITC rewards capital deployment. The PTC rewards ongoing generation output. For most CNI operators evaluating solar, the ITC is the more relevant instrument. To claim it, you file IRS Form 3468 with your federal return, and you need to maintain detailed records: invoices, contracts, certifications. One more thing on the ITC: the 5-year in-service requirement matters. If your system comes out of service or changes before 5 years, you face recapture. That is a documentation and planning discipline issue. It's not just a tax filings type issue. Now, what is Section 179D? Section 179D is a deduction. It's not a credit for energy efficient commercial building property. It applies to interior lighting systems, HVAC and hot water systems, and the building envelope. To qualify, your project must be certified to reduce total annual and power costs for those systems by at least 25% compared to a reference building under ASHRAE Standard 90.1. For 2025, the base deduction runs from 58 cents to $1.16 per square foot. Meet prevailing wage and apprenticeship requirements on the labor side, and that range increases to $2.90 to $5.81 per square foot, roughly 5 times the base. To put numbers on it, on a 200,000 square foot facility, the difference between the base and PWA compliant rates at the 25% energy savings floor is approximately $116,000 versus $580,000. If your energy project hits the 50% energy savings ceiling, which most retrofits won't, those figures scale up to roughly $232,000 versus $1.16 million. Most real projects land closer to the floor, so model against the 58 cents and the $2.90 figure first. The prevailing wage and apprenticeship decision must be made before the project is bid. You cannot go back and retrofit labor compliance after the work is done. So, who can claim Section 179D? Building owners of qualified commercial buildings and beginning January 1, 2023, designers of qualifying property installed in buildings owned by tax exempt entities, hospitals, schools, universities, government buildings. If you are a manufacturer or commercial real estate operator, you're likely claiming as the building owner. If you're an engineering or design firm working on a school or municipal project, the deduction can be allocated to you. Now, what about the construction start deadlines for solar and wind? Under the One Big Beautiful Bill Act, the OBBBA, the tech neutral credits under Section 45Y and 48E now carry firm construction start and placed in service deadlines. Projects that begin construction before September 2nd, 2025 have a 4-year continuity safe harbor and can use either the physical work test or the 5% safe harbor rule to establish construction start, regardless of system size. Projects starting after September 2nd, 2025 face a capacity threshold. Systems greater than 1.5 megawatts AC can only use the physical work test. There are staged deadlines after that. FEOC restrictions take hold for construction starting after December 31st, 2025. Projects that begin construction after July 4th, 2026 must be placed in service by December 31st, 2027. And projects that begin construction after December 31st, 2027 receive no credit at all. The window is closing. So here's what I keep seeing. Operators make project go, no go decisions based on energy savings alone, and nobody at the table is running the tax credit math until after the project is already scoped and bid. And by then, the labor compliance decision has already been made. The construction timeline is already set. You left the most valuable levers you have at your disposal on the table. The 179D deduction and the ITC are not afterthoughts for your tax preparer. They are capital planning inputs that belong in the room when you are deciding whether a project actually pencils out. If you watched episode 14 on battery storage and thought the numbers were close but not quite there, if your battery system qualifies under Section 48, check the current statute with your tax advisor. The ITC may be what closes that payback gap. And for solar, which is unambiguously covered under the federal ITC for commercial installations, that same logic applies directly. Look, I don't run your facility, okay? That's your job. My job is to bring you definitive answers to the most pressing energy questions facing commercial and industrial operators like you. So here's the bottom line on federal energy tax credits. The ITC, the PTC, and the 179D deduction are capital planning tools that directly reduce your net project cost and compress payback, but only if the right decisions are made before the work is bid, not after. So here are the questions to take to your team to make sure you do this just right. Do you know whether any energy projects currently in your capital plan qualify for the ITC or 179D? And has anyone run the actual dollar impact against your project budget? If you have a retrofit involving lighting, HVAC, or the building envelope, do you know your projected energy savings percentage relative to the ASHRAE 90.1 baseline? And does it clear the 25% threshold that opens the 179D deduction? Has your project bid process specified prevailing wage and apprenticeship requirements? And if not, do you understand the difference in deduction value between a compliant and a non-compliant labor approach on your square footage? If you're considering solar or wind, do you know your construction start date relative to September 2025 and December 2027 deadlines? And have you documented beginning of construction in a way that will hold up? If today's episode got you thinking about an energy project you have in the works or one that you're planning, I want to help you. Me and the team at Tactical Energy Group created the Energy Decision Blueprint for exactly the kind of situation that you're in. If you're an Indiana-based commercial or industrial operation spending 5 figures or more on electricity each month, and you are in energy improvement mode, projects, rate changes, equipment decisions, this process is free to you and you're obligated to nothing. We'll get on a call to understand your situation, pull the relevant data, and come back to you with a full opinion on whether your project is optimally structured, whether the payback will actually materialize, and what you may not have considered. You can click the link in the description below or go to tacticalenergygroup.com and look for Energy Decision Blueprint, and we'll get it set up for you. Thank you for listening to Energy Answers, brought to you by Tactical Energy Group. If this helped, Send it to another operator you know who's dealing with the same headache, and visit tacticalenergygroup.com to get more practical tools for your facilities.